Welcome. We are diving into a really big question today, one that affects pretty much anyone with a retirement account. Is the investment playbook that's worked for the last, 40 years, officially broken? We're going to break down exactly why the old rules might not apply anymore and what a new strategy could actually look like in this high debt world we're all living in.
Think about this quote for a second. Everyone's retirement got cut in half. Why? Because they had no cash flow from it. It was all capital gain. This just cuts right to the heart of the problem, doesn't it? During huge downturns like 2008, people's portfolios got absolutely hammered. And it wasn't just because prices fell. It was because the entire strategy was built on a single bet that the market would just keep going up. And when it didn't, well, there was no backup plan, no income, no cash flow to soften that blow.
And that leads us right here to the central question of our deep dive. You know the one, the 60-40 portfolio. 60% stocks for growth, 40% bonds for safety. It's been the gold standard for decades, right? It's the foundation of most 401ks. But in a world drowning in government debt, with economic policies changing on a dime, is this passive, set-it-and-forget-it approach really a reliable path anymore? Or is it kind of like a ticking time bomb that we need to redefine completely? All right, so to figure that out, here's our roadmap. First, we'll look at the cracks showing up in that traditional 60-40 portfolio. Then, we're going to dive into the new economic reality we're all facing. We'll see why the old rules are failing and introduce a new framework called the 4 pillars. From there, we'll get super practical and talk about building a new playbook. And we'll wrap it all up with the most important part, the mindset shift from just hoping for the best to actually taking control. Okay, let's get right into it. The 401k is, the cornerstone of retirement for millions of people, but its core design has this fundamental weakness that most people just don't see. Well, not until it's way too late.
So what does this even mean, that they're tied to the move of the market, not the move of time? Well, it means your account balance only goes up if stock and bond prices go up. That's it. There's nothing inside a typical 401k that's designed to generate income on its own. They're basically just a passenger in a car that's being driven by the market, and you're just hoping, really, really hoping, that in 20 or 30 years it ends up at the right destination.
And see, that total reliance on the market is becoming so much riskier now because the economic world itself has just fundamentally changed. To get why, we have to look at the new forces at play in this high-debt, low-growth environment.
Now, we don't have a crystal ball, right? But this formula is probably the next best thing. You've got policy. That's all the stuff governments and central banks do, like changing interest rates, printing money, massive spending. Then you've got demographics. That's the shape of our population, things like 85 million baby boomers heading into retirement. When you smash those two powerful forces together, you start to get a pretty clear picture of the economic headwinds we're sailing into.
And here's a direct result of that policy piece. A staggering 99%. The U.S. national debt is now basically the same size as our entire annual economic output. Just imagine for a second if your personal debt was equal to your entire yearly salary. It would be incredibly hard to get out from under that, right? This massive debt has huge consequences. It slows down future growth and it backs policymakers into a corner, which often means doing things like creating more currency, which in turn makes the safe part of your 60-40 portfolio, well, not so safe anymore.
Now, if you want to see what happens when policy and demographics collide in a high-debt world, look no further than Japan. It's a fascinating cautionary tale. Japan in the 80s looked a lot like the US in some ways. Housing boom, stock market bubble, aging population. But look at what happened. The market peaked in 1989, then it crashed, and then it just went nowhere for over 30 years. Can you imagine being 50 years old in 1989 and your planner tells you, don't worry, just buy and hold this diversified portfolio for the long term? You'd be over 80 today, and your nest egg would have gone sideways for your entire retirement. And this story just brilliantly illustrates what we mean by systemic risk. We're always told to diversify, right? Don't put all your eggs in one basket. But what happens when the entire basket is compromised? In Japan, it didn't matter if you owned Sony or Toyota. The entire economic system was struggling. So when the risk is systemic, your traditional diversification just isn't going to save you. So, if the economic reality has totally shifted and systemic risks are way higher, that means the old rules of investing need a serious update. The advice that worked for our parents might be exactly the wrong advice for us. This chart really shows the huge shift in thinking we're talking about. The old way is all about capital gains. You buy something and you hope its price goes up. That's it. The new way is all about cash flow. It's about building a system that generates predictable income whether the market is up, down, or just moving sideways. It is literally the difference between hoping for a good outcome and actively engineering one. So let's just bust 3 of the biggest myths out there. Myth number 1, diversification will always protect you. We saw with Japan that completely fails when the whole system is shaky. Myth 2, buy and hold is a guaranteed path to riches. Well, that quickly becomes buy and hope if the market goes flat for decades, right when you need the money. And myth 3, a rising stock market means your portfolio is healthy. Not necessarily. If it's just being propped up by money printing, those rising prices on your statement might just be an illusion, not a reflection of real economic value. Okay, we've spent a lot of time on the problems. Enough doom and gloom, right? So what's the solution? How do we actually navigate this new world? Well, it starts with a new framework for thinking, a repeatable process to guide our decisions. The biggest enemy of any investor isn't the market. It's emotion. Fear makes us sell at the absolute bottom, and greed makes us buy at the very top. The only way to fight that is with a system, a set of rules and principles that you follow every single time. And that's what the 4 pillars are all about. Creating a process that lets you make smart decisions based on data and strategy, not gut feelings or panic. And here they are. Pillar 1 is fundamentals. That's looking at the actual health of something, whether it's a country's economy or a company's balance sheet. Pillar 2 is technicals. This is about understanding market trends. You know the saying, the trend is your friend? You don't want to be fighting the market. Pillar 3, cash flow. This is the real engine of the new playbook, focusing on strategies that actually generate income. And finally, Pillar 4, risk management. This is about controlling what you can control, how much you invest, your exit plans, and always protecting your capital. Okay, so we have the framework, but a framework is pretty useless without a practical playbook, right? So how do we take these pillars and turn them into an actual actionable investment strategy? A modern portfolio might look really different from the old 60-40. In this model, maybe 50% is in your core, high-quality investments. 10% could be for more speculative, high-risk plays. But look at that huge 40% slice, cash. Now, this is not dead money. This is your opportunity fund. It's what people like Warren Buffett do. You build up cash so that when the market inevitably corrects, you're ready to swoop in and buy great companies on sale. Cash gives you options. Cash gives you control. So how do we make those core investments actually work for us? This is where a strategy like the wealth wheel, or what some call a cash flow cycle, comes in. It's an active way to generate income from the stocks you already want to own. It turns a static asset that just sits there into a dynamic, cash-flowing machine. And I know it sounds complex, but the logic behind it is actually super simple. Let's walk through this carefully, step by step. Step 1, you sell puts. Instead of just buying a stock at today's price, you sell a contract where you agree to buy it if it drops to a lower price that you pick. And here's the magic part. You get paid cash, a premium, right up front just for making that offer. If the stock never drops, you just keep the cash. If it does, you get to buy a great company at a discount. It's a win-win. Then step 2. Once you own the stock, you collect any dividends it pays out. That's a second income stream. Step 3. You sell covered calls. Now you're essentially renting out the shares you own. You sell another contract that gives someone the right to buy your shares at a higher price. And again, you get paid a premium for it. If the stock hits that price, you sell for a nice profit. If it doesn't, you keep the premium and your shares. Then you just rinse and repeat the cycle, creating multiple streams of income from just one asset. Ultimately, all of these strategies, all of these frameworks, they all lead to one big, transformative idea: shifting your mindset from being a passive passenger to being an active driver. It's all about control. This right here sums up the whole journey. The old mindset is about just handing over responsibility and hoping for the best. You hope the market goes up. You pray you have enough for retirement. You rely on somebody else to handle it for you. The new mindset is about taking ownership. You build a system that's designed to perform in all kinds of conditions. You plan for a secure future by creating predictable cash flow. You educate yourself, and you take control of your own financial destiny. And that really brings us to the most important takeaway of all. Look, you can't control the market. You can't control interest rates or government policy, but you can absolutely control your own actions, what you buy, how much of it you buy, and when you decide to sell. You control your strategy. And just remember, true financial security isn't just a big number on a statement. It's reliable, consistent cash flow that covers your life no matter what the market is doing. So we'll leave you with this final thought to chew on. A gambler places a bet and just hopes for a specific outcome they can't control. An investor builds a system, manages risk, and engineers a predictable result. So given this new economic reality, which one do you want to be?